It is 7:45 a.m. in New York, but I wanted to get this video out on Silicon Valley Bank, ticker SIVB. And yesterday we did a video on banking, runs and what that might mean. And a great question came up, and David was very focused on Silicon Valley Bank. However, he's in California, so it's like the crack of dawn over there. So we chatted, but I wanted to go ahead and do this follow-up to show it to you guys very clearly what's going on with Silicon Valley Bank, because you've got the stock plummeting. You've got a lot of investors and VCs that are coming out with very big names that are saying, hey, get your money out of Silicon Valley Bank. And then you've got this really hodgepodge mixture of stuff that people are just reactively saying. I want to give you the financials so that you can sit there and make your own decision. And I figure some of you guys actually do bank with Silicon Valley. So this isn't just kind of a, oh, should I play it in the stock market sort of thing? For some of you guys, this is really important to making sure that you don't end up as an FDIC paid sort of situation. And I will say this, the bank side and Silicon Valley has a bank and it has a number of other corporate structures. You want to make sure that you're in the bank side, whatever it is you're dealing with them, because that's FDIC insured. Some of the other stuff is not. So at a minimum, if you're listening to this, to start off with, go and check what exactly it is your deal, and that the account that you have is FDIC insured, because there are different parts of that bank that are not. Okay. And they're usually really clear on that. They're not hiding anything. All of this is fully disclosed. But I do want to talk through what happened yesterday and how to think about it. I have no position on this whatsoever. I have no dog in this fight. Past performance is not indicative of future returns. And honestly, long or short, me personally, I kind of want to stay out of it given what I'm seeing. But you guys can do your own decisions on what it is you want to do. The reason I'd also want to stay out of it is I have been long this stock before and short this stock before. The liquidity on it is something special. Also, additionally, because right now it's very clear that people are playing this in a very particular way, the movements are going to shift aggressively. So unless that is your expertise, I really do recommend you kind of stay out of it. Okay, now let's go ahead and go into this. Yesterday, I did a number of commentaries on what causes a bank run. And so I'm just going to very briefly review that slide for you. A lot of people think that it's just one asset that goes bad and then suddenly you have a bank run. In fact, that's not really quite fair. What actually happens is that the customer deposits. So when you deposit money in a bank, that sits in the liabilities side of the balance sheet because it's not their asset. They're holding that asset and using it to do a set of activities to make money. Okay. So a bank run really is the collateral of the liability, which is the customer deposit, starting to seep out faster than what is required by law for you to hold on all of this other stuff that's investments. Now, in the past, something like a Credit Suisse, what you had was kind of the exact opposite happening, which is the non-liquid stuff, some of which could go beyond zero, which is truly toxic, coming down in price and then just making it impossible to have enough capital to pay back customer liabilities. So it's kind of a weird thing in this regard because the two are very circular. And what happens in a bank run is a collapsing of the balance sheet. It is not ever just one-sided. It is two-sided in every single circumstance. Okay. All right. If it was one-sided, you could very easily fix it. That's the issue. Because it's two-sided, it's not the most obvious thing to fix. All right. What happened yesterday, or actually before we go into what happened yesterday, I want to talk about this. Silicon Valley Bank, and I said this yesterday and I realized that it made no sense. So when we got off camera, we had a longer conversation and I realized why it made no sense. Normal banks, their primary form and method of making money is to make loans. Deposits that they take in are not necessarily correlated to those loans. So in other words, even though you might have someone that's depositing money and then taking a mortgage out with the same bank, it's not like they're still making their money from something else, okay? They're not necessarily, so some employer is paying them and then they're paying off the loan. And so there's things that you can do there. Silicon Valley Bank is different. With Silicon Valley Bank, what happens is that the VCs give money to a company, then the company does a set of things that either increases or decreases what's going on the balance sheet, on the deposit side. And let me show you that and then come back to this slide. I made this little cute little chart. Okay, listen, I'm not that advanced in PowerPoint. I know some of you are more advanced. But basically, this is how, for people that are not knowledgeable about VC, that don't know a lot about that part of the market, what happens is that a young company will get financing from an angel or a VC investor, whoever it might be, okay? And they'll stick it in Silicon Valley Bank. They'll open a bank account. And then once they open the bank account, hopefully they generate some revenue. Maybe they get, and often they get, additional rounds of financing, Series A, Series B, Series blah, 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 right? And then if the company exits and liquidates, they will absolutely... Exactly. Okay. So if the company exits that, then the cash goes into the bank in a particular, and that is by large way beyond anything else. That's what that's what's going on. So that's what I mean. So for example, that's what I mean by the idea that deposits are correlated with the investment side of the balance sheet, because the biggest way that Silicon Valley Bank makes money is the companies themselves do more financing and get more deposits as a function of that. And I'm going to show that very clearly by going through the balance sheet. So anything else you're hearing, yes, they do housing loans. Yes, they do traditional banking. Yes, they do all those things. But I'm going to show you on the balance sheet why that's a little bit irrelevant in this particular problem that they're experiencing. Yeah. Okay, so let's actually look at the balance sheet now. Here's what it is. If you look at the assets, net loans is 73. This was from Q4 year end. Okay, this is the snapshot that we got on December, realizing that we're about a quarter in. If they had not said anything further, we'd be entering the quiet period. So it's kind of like they needed to do this whole bag of stuff before they move forward. But you can see very clearly that it's the private equity. It is absolutely not the loans themselves. And in fact, that is like we'll go back to that in a second. But if you look at total deposits at December, that was 173, already coming down from year over year. That reflects what's going on in private equity, VC, et cetera. The lack of deal flow, the lack of funding is actually creating a problem for these companies that were maybe early stage venture and would have needed one or two more rounds of funding. So you've got these venture companies that are drawing down capital out of the bank account. So deposits are declining because the nature of their client base is cash flow negative, for lack of a better way to say it. The business loans that are clients that form the bulk of the clients. Then on top of it, the VCs are cutting off the money faucet. That's what's actually going on. And that's how you end up with a company at December that has 173 billion in deposits, but has net loans of only 73 billion. And I'll show you what the CET is, somehow needs to raise a ton of capital. Now let's talk about, also, I want to show you the CET, and then I'll show you what happened yesterday. The CET ratios at the end of the year were a whopping 12%. Okay, so I want to show you this. 12% for the financial piece of it, 15% for the bank. Okay, the SVB financial from their documents is not FDIC. That makes sense because only a certain type of funding is actually is FDIC insured. You have to be a proper bank. SVB Financial is doing more almost like pseudo. It's not quite right to call it an investment bank, but it's more like a capital markets, cap intro pieces of an investment bank. Let's say it that way. Okay. That's more what SVB is, financial is. If your money is there, yeah, you got to move it into something that's FDIC insured, remembering that FDIC insured only insures up to $250,000 per bank. So they will sum it up. You cannot have two accounts with 250 and 250 and expect FDIC to insure both accounts. They will only insure up to 250. Move your money to another bank if you're thinking that FDIC is going to somehow insure you, if that's the case. Okay. So the bank itself was insured to the tune of 15% on CET capital, tier one risk-based capital, which is high. And they were already telling you in the last call that they were concerned at how fast deposits were leaving the bank, and also they were trying to help very much so their customers raise capital, because again, early stage venture running through as aggressively, this is not the easiest thing. Additionally, they told you that the major format that they were able to get that financing was debt from, again, still the venture world. So that is where they were at on the snapshot. That is where it was at on the snapshot on December 31st. And now what happened here, whoops, what's covered under FDIC? Here's your balance sheet. And then what happened just the other day was this. There were three things that you kind of have to watch for. The first thing was this, the 1.25 billion of common stock plus 500 million of depository shares. 2, right? 3, to the extent that they're able to get this funding, this Series F funding off, they were also going to immediately, because they had a joint agreement of investment with General Atlantic for $500,000. So this is $2.25 billion worth of capital to be infused. It is absolutely dilutive. Okay. If you just look at it, it's very obviously dilutive. And that's what freaked out the market. Additionally, they sold $21 billion of securities. Now, yes, some of this could have been loans that needed to mark. I don't think so, though. I think most of this was any kind of stock that they received, because Silicon Valley Bank often does, as a function of helping small companies, get a slug of that for when the company goes public. And given what's happened in capital markets, they were probably like, you know what? We don't necessarily need the equity risk that we're holding. I'd rather just sell that off, raise capital. But so you raised 21 billion worth of capital there, and then you did this other stuff as well to raise an additional $2 billion of capital. That is going to freak people out. Why do you need, given that you reported that you had a 15% CET capital ratio, why do you additionally need all of this other capital? Now, again, like I said, the use of proceeds, they said, was just for consummation of each offering, not contingent. Okay, sorry. Use of proceeds from the offering is for general purposes. Okay, so there wasn't a big deal they were trying to do. There wasn't any use for the proceeds other than to just stay in business. That number is just really big, is what it is. Between the 21 billion that they sold to have cash, which in fairness does come out of assets, so we don't know how much of a discount that mark was. I think the markets were saying it was about $1.8 billion in loss. So, but the fact that they did, so why would they do that if it just comes out of assets? That had to have been not tier one capital. So that had to be capital that was not going to be included in tier one unless it was liquidated back into cash. So that can be any kind of really unique convertible product that you have. It can be stock for sure. That has the wrong liquidity profile. It can be private equity that you own that you just need to get rid of. It can be any number of assets that absolutely would not qualify for tier one. But the fact that you liquidated it, even at a loss, and then you still needed more capital, it freaks people out, because because instead of just announcing it at the quarter, you're announcing it in advance of going into your QP, your quiet period before reporting. So that to me is what is going on. So the company then, I believe, did a call late in the afternoon to try to get people to calm down and keep assets in. The real challenge that, like I said yesterday, is that once you have a bank run started, a bank run can happen both because you had some kind of loss. Here, 1.8 is a meaningful loss on a bunch of stuff, but it was probably semi-liquid stuff that they just went ahead and took the mark on, not the crazy stuff that was truly toxic, is my guess. And then it can be, but then once that happens and people freak out, as the customer deposits decline, as people start pulling capital, it puts more pressure on the assets to meet CET capital requirements. And again, CET capital requirements are required for banks and also if you are a bank, then it makes your whole entire organization be required to be subject to those rules. So even the parts that are more investment banking like are like that as well. And that is actually all I had prepared because it is first thing in the morning. So I also have to get to my trading day. I don't know if there's any questions, so this might just be a really quick dialogue. Yes, that's right. They are not like a traditional bank. Oh, sorry, you're right. But this is a great palm PDB, so I appreciate it. You're totally right on this. They're not a traditional bank, and really, traditional banks do not have this type of exposure. And I would also add to that, this is really great. I would also add to that that part of the reason they are not like a traditional bank is that their primary business is absolutely, I'll go back to this slide. Traditional banks, first of all, they might do this one off, right? But they don't do this as the core part of their business, which is supporting VC backed companies. And if you think about it, one of the things that was a little bit disturbing was it was really VCs that were coming out saying, hey, you guys should take your money out of this bank. That's a problem because VCs saying that and them being the primary funders of all these little sub companies are telling you that basically what's happened over the course of the last 2 quarters is every time one of these small companies has gone to the VCs to ask for money, the VC's like, no, I'm sorry. I really needed you to actually be profitable and not just be like needing cash from me all the time because basically the capital markets are closed. So I don't really have the same economics on an exit strategy. Now, almost no other bank that I know of in the S&P 500 has this kind of exposure. Even the investment banks do not have this type of exposure. So it is possible that this is contained within Silicon Valley Bank. That said, there are probably smaller banks that may have attributes like this. I would also say, and reiterate what I said yesterday, part of the reason Silicon Valley was on my list as kind of the next tier, and then what happened yesterday didn't give me time because I was still trying to cover everything else, was because a lot of the VC funding was, not all of it, not even a meaningful amount of it is involved in crypto, but I would say some of it looks crypto adjacent, and additionally, some of it is fintech. And fintech has its own special sauce right this minute because it's like, just look at my videos on Upstart, look at my video on all these other companies. A lot of them during this period of time, even though you're a neobank, once you start looking like a bank, then I have to start judging what you're doing relative to whether a bank would blow up. And more than one company does look like a bank that's about to blow up. And I will, now that I'm through, I have like about 50 more companies in the S&P 500 to look at, but then I'll start immediately trying to cover some of those smaller neobanks because I know that a huge portion of the population only has access to the financial system via those types of financial services. So if it's going to be an issue, I would love to just make sure that you at least have something where someone actually went through the financial statements and it's not just a bunch of rumor where you can't actually even back and fill what it is they're coming from. I'm not seeing too many questions here. Let me just look. I guess it's very early in the morning. Hey, Wes. Hope things are well in Tennessee. Just want to give a shout out to Wes. Raw fish, I'm not sure what you mean by this, but thank you. Or Talufa sister, I'm not sure. Raw fish king, I'm not sure what that means, but good morning to you as well. Ham, I will take a look at this AVCT. Thank you for that. I will take a look. And all right, we'll keep this short. Good luck, you guys. I will say that the market's going to have to digest this. So this could just in general end up being kind of a rough morning for traders and the such. Anyway, put the comments below. You guys know I always answer them personally. And have an amazing morning and trading day. Bye, guys.